Should we get started, Bill?
Yep.
All righty. So let's start by saying thank you all for joining us this morning. We're going to have a great time together. I feel like people who wouldn't have a great time listening to things about inventory are in here. So we can safely say that we'll all have a good time. My name is Gershon Margolis. Some of you know me, some of you don't. I am the founder of Imperial Advisory, which is a small agency that provides part-time CFO services. At this point, we've got 2 CFOs, a few junior people, one of whom is Isabella, who I believe is on this call or will be here. Anyway, so we all know what's going on now. Times are rough. Companies need money, and something that we as CFOs and really every business owner, whether they have a CFO or not, needs to think about is cash flow. So when people think of cash flow, often they think about when they pay people, when they pay their vendors, when they pay for supplies, when they pay employees, when they get paid by their clients or customers. And that is definitely part of cash flow. But one very important part of cash flow, which is often overlooked, most probably by people not on this call, is inventory. I was introduced to Bill a while back by a mentor of mine who actually is a really, really great guy, an experienced CFO and consultant and everything, named Bob Doyle or Robert Doyle. And I heard, I think part of this webinar that we're going to have today, I heard part of this at an event put on by Steve Ramarini last year at the Compel CEO's annual event. So Bill is really very knowledgeable, very experienced. If you ever have the chance after this is over to go for coffee or lunch with him, he's got a great story as well. And Bill is here to talk to us about inventory and how we have this large chunk of money tied up, but it doesn't look like money. It looks like supplies. It looks like raw material. It looks like things that we think we need, but it's really there in plain sight, and it's there to be converted into cash. It's an extra source of liquidity for companies, for our clients, for your clients, and for everyone. So without much more comment from me, I would like to introduce Bill and say how pleased we are to have him, to be collaborating with Bill Schoolman from Schoolman Inventory Method. This is a picture of Bill. Today he's wearing a hat, but you'll still recognize him. He's going to be the guy talking. Take it away.
Okay. Well, thank you. Can you hear me clearly?
Yes.
Okay, great. All right. So today we're going to be really talking about cash flow, which is the lifeblood of every business, and particularly in the current environment where the virus has basically killed lots of revenues. If on March 1st, 25% of your inventory was, as I defined it, to be excess, today it's 50%. So the amount of excess inventory, which is essentially wasted working capital, has probably doubled in the last 30 days. It's a pretty serious problem. And excess inventory, does not pay for operating expenses. So again, cash flow is everything, especially in today's environment. I've seen situations where recently, where the amount of excess inventory went from one particular company from 20% up to 60%. So the Schoolman Inventory Method will produce some quick results on portions of excess inventory, not necessarily all of it. Some of it takes longer to get rid of. And everything that I'm going to discuss that requires data should come from anybody's normal ERP system, no matter how clean the database is in that ERP system. So We're going to develop some diagnostic methodologies that we're going to discuss, and all of it will come from anybody's ERP system. Furthermore, I've developed an algorithm that I guess I developed it out of necessity, that predicts how much of a discount you're willing to take on excess inventory when disposing of it. And it's based on the economics of your own firm, particularly the carrying cost of inventory. And we're going to go over that in detail. I've also, this is to be helpful. Everybody has problems getting rid of inventory. Some of it, if it's retail items, it's a little bit easier. I made a relationship with a gentleman who's got 30 resellers of inventory, highly successful at that, with international experience. So if somebody can't get rid of the inventory on their own, I have found a resource that I refer people to. So it's sort of like one-stop shopping. I don't get involved in the transaction, but I'm happy to recommend him, and he's very successful. He's had about an 80% success rate with the clients that I've already thrown to him. In today's world, it's really just smart business to focus on excess inventory, not just because of the virus, but just because excess inventory is always a problem. Before the virus hit us, I would say my observations are that about the average business had no less than 25 to 35% in what I would define to be as excess inventory, which is essentially just wasted working capital, taking up lots of valuable space. So proper inventory management has a very dramatic impact to both the P&L and the balance sheet. Can I have the next slide, please? Okay, so here's no, go back one. Thanks. Here's a quick outline of what we're going to cover today. We're going to define what excess inventory is. We'll look at the recent trends in it. We're going to cover some metrics. We'll discuss the Schoolman Inventory Method. We'll discuss how it impacts the bottom line. And we'll talk about resources for disposal. And when we get an inventory due diligence, and when we get into the process, I've added a lot of slides on actual results of analyzing and getting rid of the inventory. So it's all practical stuff. Next slide, please. All right, so the Schoolman, what's happened is over the years, I've been doing this a long time. I'm an engineer by background, and ever since my undergraduate work at Lehigh, I was always interested in inventory. If you look over on the left-hand side, you'll see 8 elements: SOS, diagnostics, stocking indicators, SKU forecasting, DRP replenishment, carrying costs, stock status, customer service, and financial controls. I consider that to be the 8 essential critical elements of a high-performance inventory system. If you look across the top, it says identify SOS. SOS stands for surplus, obsolete, and slow-moving. That inventory gets converted into cash, which is part of then your financial controls. So you sort of got a little flow chart over here, and the whole goal is at the bottom. Turnover and service objectives. And the financial rewards are you increase inventory turns, which frees up working capital, reduce stockouts, which increases sales and gross margin, reduces operating costs, and increase in GP dollars when you maximize, and we're going to spend some time on this, GMROI, one of the most important metrics you could ever have. That stands for gross margin return on inventory. Can I have the next slide, please? All right, so in defining excess inventory is essentially the difference between what you've got and what you really need. It's the hidden treasure on the balance sheet, dead dollars, sitting on shelves, floor, wasting space, produces no usable gross margin. If you've got dollars tied up in something greater than a 12-month supply of a particular SKU, you're not going to be paying any operating expenses with that money. So that's why it's all about cash flow. So it serves no useful purpose unless you got, when the tariff increases hit about a year and a half ago, people overstocked if it's a commodity item, but it's rarely justified. Next slide. So in the past 5 years, systems and technology have gotten much sharper. So the tools have gotten better. That means you don't need as much inventory. But at the same time, the costs of owning the inventory, which are called carrying costs, have increased. And I have a couple slides later on that. So unless you're using the latest technology, before the virus, you were carrying 20 to 35% in dead dollars. That's a good way to think of it. Excess inventory is dead money. So converting dead money into cash has a dramatic improvement to the bottom line. And it's also protection against profit challenges. Also easily corrected. The methodologies I'm going to show you augment into any existing ERP system or whatever made-at-home job someone may have. So there's no need for drastic, expensive changes. Next slide. So let's go over some basics. I want to talk about metrics. Metrics is everything in inventory. So let's start with some real simple ones. Inventory turns is the ratio cost of goods sold to inventory. So let's just say company X has a sales at cost of $3.5 million with $1 million inventory. And so we would define that to be 3.5 turns a year, which is the amount of times your investment in inventory turns over. You want the highest possible number without it hurting customer service. In the food distribution business, if they're not getting 25 to 30 turns on some of their items, they're in a lot of trouble. So the highest the number means less working capital. Next slide, please. I prefer to look at inventory in terms of weeks of inventory, which is really, it's just a algebraic reversal of turns. And I've given you the equation there for it, which is 52 times the dollars in inventory. And by the way, that inventory should be an average inventory, just in case it's a seasonal industry. You take it at the beginning of the year, mid-year, at the end of the year, and we would describe that 52 times that divided by the annual sales of cost. So if you're getting 3.5 turns, that's 14.8 weeks of inventory. We're going to talk a little bit about a publicly held company, Party City. They carry 22 weeks, 22.4 weeks of inventory at the retail level. Their lead times at the store level are 1 week. Sometimes they get deliveries twice a week. So you ask yourself, what are you doing with a 22-week supply per SKU when you've got such short lead times? So I like looking at weeks of inventory or months of inventory. It's because immediately you compare it to vendor lead time. So if your vendor lead time is 1 month and you're sitting with 8 months of inventory, right away you know something's wrong. Next slide. Customer service level. You own inventory, you've got to measure the level of service you provide to your business. By mistake, I left one out there. So customer service can be defined in lots of different ways. Sometimes people will use all these measures depending on how competitive the industry is that you're in. So that first one there, percent dollar demand satisfied on time. You could have percent back orders, percent out of stock, percent lost sales, and also percent fill rate. So it's an indicator of lost sales and disservice. One thing I've observed over the years, this is so true. I did a lot of work in auto parts and industrial parts, etc., at one particular time. And in general, the guy who has the highest level of service to his customers always wins, always has the most gross profit dollars. Why? Because he has it when you need it. So next slide. We're going to talk about carrying costs. Carrying costs are the cost of owning. And there's two types of carrying costs. There's a total cost and an incremental cost. If we cut the inventory by, let's say, 10%, it may not affect your cost of floor space. So the elements for carrying costs are floor space costs, utilities, excessive material handling, shrinkage is a big one. Don't confuse that with obsolescence, insurance, and interest costs, capital opportunity costs. Whenever you're looking at your carrying cost, you don't want the cost of capital. What you want is, and we're going to have a slide on this, you want what's called the opportunity cost. That's very important. And that's important for figuring out the impact to the bottom line. Now, in a retail business, your carrying cost could be 45 cents per dollar of inventory, primarily because the space cost is so important. If you're an industrial distributor and the parts have low economic value, could be as low as 20 cents. Next slide. Now we come to this. This is the single most important metric in any measurement of any inventory system because it encapsulates all the others. It really is a measurement that sums up the impact of service level, turnover, carrying cost, etc. And it's a very simple equation. GMROI is gross profit dollars divided by inventory dollars. And later on, I'm going to show you a different equation to use, but it's the same thing. But it's the single most important metric in measuring the performance of an inventory system. And you average it over all SKUs when looking at a business, but you also, I'm going to show you some diagnostic techniques that look at the GMROI on an individual basis. So what's interesting is that when I was looking at Party City and I was able to get a lot of their data off of 10K, and I figured out they had 22.4 weeks of inventory at the retail level, that distribution of all those SKUs follows what's called a normal curve. Some people think of it as the bell-shaped curve. So if you're sitting with 22 weeks of inventory, that means 50% of the items are more and 50% are less. Well, the same thing works with GMROI. So let's take company X over here with 10 million in revenues, has a gross profit percent of 35%. So their gross margin is 35% times 10 million is 3.5 million. And he's got 2.4 million in average inventory and 12,000 SKUs. His GMROI is $1.46. Now that ratio means that's the amount of margin that each dollar of inventory produces. And if that number is less than $1.75, or really 1.75, because it's a metric, what it always means is there's profitability and cash flow issues. It means you're not getting enough margin out of your investment in inventory. Now, is the numerator and the denominator. Either you've got too much inventory or not enough margin. And I'll show you. Take a look at those are 4 publicly held companies. Party City, $1.64. Walmart, we all know how successful they are, $2.79. Target 2.50 and Costco 1.91, and they make a lot of it off their memberships. So I made a real aggressive attempt to get Party City's inventory assignment, but they were, just full of their own. They had a legacy system that had all kinds of excuses why it was the way it was. Next slide, please. All right, now here's an interesting way of using Gimroy to analyze what's going on. Take a look. We have vendor A and vendor B. Now, let's start with vendor B, importing from China. I do a lot of work with importers. When you import from China, if you allow 1 month for the manufacturing time and then on-boat time, you're probably talking about an 18-week lead time, and hopefully you're getting at least a 40% gross margin. Now, for vendor B, if we buy our product from him, we'll get 40% margin, but we'll only be able to turn our inventory 2.5 times. And let's just say we get this data from empirical experience. All right, now things get tight. Now let's take a look at vendor A. Vendor A only has a 25% gross profit if we buy it domestically, but there's a 3-week lead time, which means I'd be able to get an 8-time turn. So which one do you think would be better? I say we can use that Gimroy calculation. I should really refer to it as the Schoolman Index because I've been using it way before it became popular. Next slide, please. Take a look at that equation at the top. SIMI, that means Schoolman Inventory Method Index, same thing as Gimroy. Another algebraic equation for it is you take the gross profit percent, multiply that by the turnover you can get, and divide that by 1 minus the gross profit percent. So that's the same thing algebraically as gross profit dollars divided by inventory dollars. So if I take that equation where I know gross profit percent and I can guess at inventory turns, vendor A, 2.67. Vendor B, with the larger gross margin, only $1.60. Next slide, please. So, I think something got cut off at the bottom. There's that's about I think a 46% or 58% increase in profitability going with the other vendor. So let's go back to company A. He's got a Gimroy of $1.46 and he needs to be at $2. Whenever I work on a project, I always shoot for $2. And whatever it takes to get that thing up to 2 is what we do. Now, this is real data. This guy, this was about 4 years ago. He was able to recover 80% of the excess inventory at cost. It took 6 months to get it done. So 80% of the $650,000 in excess inventory is cash of $520,000. Now, when you do that and you get rid of that inventory, you now reduce your carrying cost. And he had a carrying cost factor of 25%. So that's $162,000 each year. And I just looked at it over 3 years. So I brought in an additional $487,000 in cash. And so over 3 years, he improved both the balance sheet and the P&L by close to cumulatively about $1 million. Plus, when you do this, if you're overstocked on slow movers and understocked on fast movers, you're going to get more margin because you're going to reinvest in the stuff you're out of stock on. So that reduces lost sales. And there's a huge tax credit for privately held companies. It's always interesting that privately held companies always want to get rid of inventory and publicly held companies always want to find inventory. Next slide, please. So getting rid of it, we're going to get into a lot more detail on this, but essentially return to vendor, liquidators, barter, create a use of the internet, and specialized website. And like I mentioned earlier, I made this connection with this guy who's got 30 resellers with worldwide experience. So that's helped out a couple clients, and not awful lot, who had trouble getting rid of inventory. Next slide. I want to talk about due diligence. Due diligence is collecting some preliminary data. And what it does is it establishes priorities and efficiencies for improving turns. It will specifically identify the SKUs that don't contribute sufficient gross profit. It's a critical part of the due diligence process whenever you're dealing in an M&A transaction. If you own the inventory and you want to sell your business, which is the most common transaction, and you've got some blemishes in that inventory, you'd want to do this due diligence to clean it up a little bit to make it more marketable. Now, at one time, you could get to a maximum of 16 different proprietary diagnostic reports, basically out of the same database that I'm going to discuss. Right now, I'm focusing maybe on the top 10, but it could be, as in one situation I actually ran into, it was close to 16. Next slide. All coming from the same database. I'm going to talk about 10 reports that look at the database differently. What we're looking for is clues, patterns, and action items that increase profitability. I recently had a terrific experience where in the analysis of the gross profit percent of each SKU, the company discovered, when I ran these reports, that by surprise, they had an awful lot of stuff that they were billing out at where they weren't really realizing the margins that they thought they were getting, because they had different prices for different kinds of customers, and they were doing way too much discounting. So each one of these reports is driven by 9 metrics. And these metrics, which are also analyzed by individual SKU, they're highly efficient procedures for cleaning up anybody who's got a database with all kinds of errors, because all the SKUs with database errors either go to the top of the report or the bottom of the report. So, you'll rerun these reports till you get rid of all the errors. It's highly efficient. It produces a very high return on investment for a growing business, because that cash that you're freeing up is great for marketing. And I mentioned earlier, it's important for M&A. Next slide. So we're going to identify the excess inventory by specific SKU, get some totals on it, and it's going to be divided up into 3 categories. I call it SOS, surplus, obsolete, and slow moving. And we will identify the SKUs that don't bring in enough margin, SKUs that reduce turns, and essentially we're going to measure the marketability and cash flow projection for a total inventory, using much of the same kind of concepts as you would when you looked at, when bankers look at accounts receivable. Next slide. I mentioned that it's going to create stocking indicators. A stocking indicator is a way of segmenting the SKUs into manageable groups. If you've got as many as, let's say, 50,000 SKUs, you can't treat them all the same. So, if you do a project in sporting goods, you're going to be looking at an awful lot of SKUs, size, color, things like that, categories. It also provides the input to create an aggressive marketing plan to get rid of the inventory. Essentially, using these diagnostics makes an inventory project self-funding and always results in increased profitability through liquidity. Again, I like to repeat it, excess inventory is wasted working capital wasted space. Next slide, please. So now we're going to discuss a situation where I use 7 reports. And the reason I want to discuss this particular one, this is a real company, but I've identified him as Acme Widgets. He's got 5,000 SKUs, 3.5 million in inventory, and he divides up the categories by SKU, by class, by section, and something that he calls categories. So that's important because you're going to want to sort the final results by whatever classifications are possible. And you may even also include vendor. Sometimes it's helpful if there's just a limited amount of vendors, you'll find which vendors are dragging you down. Now, I want to show you a typical inventory aging results. This is real data. It's about 3 months old. So it's a company I'm working with. I want to explain this chart because this is the inventory aging report. It's one of the 10 reports that I normally work with, but it's a critical one. So over on the left-hand side, you see the inventory dollars. He's got 3.6 million. And by the way, he's an importer. He's got 3.6 million in total inventory. Now that first column where it says 6 months, that's the amount of inventory that would be left if all the SKUs continued to sell at the same rate. So he starts off, he's got 3.6 million, but 1.5 million would still be with him if sales continued for this next 6 months. And you see it there at 6 months, 12 months, 18 months, 24, and 60. So go to that last column there on the right, 60 months. That's $700,000, 19% of the total inventory. For all intensive purposes, that's greater. That's a 60-month supply or greater. So that includes all the obsolete stuff, etc. But from a cash flow standpoint, you know, you have to, if you get materials, unless you get really extended terms, for most people, anything greater than a 6-month supply is essentially useless cash tied up in working capital. It's not producing cash for you to pay bills with, certainly at 12 months. So this is real data. Now, this guy had never cleaned house. So that's what you expect to get. And, you know, one of the interesting things is margin always hides all problems. You got a lot of gross profit, you slip and slide in other areas. And that's what happened here. This particular company used to do about, twice the revenue 10 years ago. Competition came in, margins came down, revenues came down. And if you've never cleaned house, this is what's going to happen. Next slide. So here's some statistics from that analysis. It comes out of some of the reports. Just look at this. Out of I think it was 5,000 SKUs. The bottom 30% of the SKUs, which is 1,500 items, represented 0.1% of sales, but 13% of the inventory and 0.1% of the GP. The GP followed sales at cost, but and that doesn't always happen. So each of those 1,500 SKUs at the bottom 30%, and they also did less than $100 a year, but their number one SKU was over $150,000 a year. So 50% of the SKUs had a GIMROI of less than 1.5. So you could sort of see where this is going. All the metrics are available in all these different reports, and you sort it different ways so that you can immediately create an action program. Next slide. I think you skipped one. Oh, no, that's it, right. So here's just another graphical way of looking at it. You see that 0.1%, 99.9%. 70% of the SKUs was 99% of the sales at cost. And there on the right, you see it by inventory cost. People love pie charts. Next slide. All right, now this is important detailed data, so we're going to spend a couple seconds on it. In the right-hand side, look on the right-hand side, you see ABC, percent SKUs, percent sales. That's, by the way, percent sales at cost, percent inventory, and percent GP. That was the raw data. So 20% of his items was 85% of sales, 65% of the inventory, and 85% of the gross profit. And the B's and the C's, that was an initial slice of taking the top 20% of the SKUs, the next 20%, and the bottom 60. So 60% of his SKUs brought in only 4% of sales at cost, but it was 23% of the inventory. That's way out of balance. So we're going to deal with that. So now I take that raw data and I break it down to this chart at the bottom there, and we take a look at sales at cost, dollars of inventory, dollars of GP. All of that data was available to me in cumulative totals in a report of the 5,000 SKUs. If you take the dollars of inventory, sales at cost, the GP dollars, you can calculate inventory turns, how many months of inventory it is, and what the GMROI is. So you could see that allows me to zero in on take advantage of an efficiency of especially straightening out the A items. So the A items had 4.6 months of inventory. Now, that'll be an interesting number in a second, but you can see what's going on. Look at the GMROI column. So on his A items, he's got a GMROI of 2.1, which is terrific. But on the B items, 1.4, and the C items, because he's so overstocked with 34 months of inventory, it's 0.4. And the totals at the bottom. What's also interesting, take a look at the total in months of inventory. You see the 6 for the total. That's the weighted average of all of his items, getting 2 times turn. What's important to recognize is that 80% of that number, 6 months of inventory, comes from his performance on the A's, which was, 85%. So 85% of the 6 comes from the A's. That means focus on the A's first to get it cleaned up. Next slide. So let's just take a look at the A group. If you need some quick cash, immediate liquidity, take a look at what's going on with that A group. We had 6.12 million sales at cost. The actual months was 4.6. The target is 3.5. That means he's looking at 1.1 months in excess dollars of inventory in the A group. Now, these are the fast movers. These are the ones that are most marketable. Now, if I took the sales at cost divided by 12, that gives me sales at cost per month of 510,000. And I've got 1.1 months of excess. That comes out to be $561,000 of excess A's. You can expect to retrieve in normal times your full gross profit on A items because they're the high demand items. And by the way, that was 16% of the inventory is excess A's. So by focusing on 20% of the items, we can raise the GMROI, increase the turns. The GMROI, getting rid of that excess inventory, would raise GMROI from 1.6 to 1.9, and that is a direct ratio increase in profitability, gross profit dollars divided by inventory dollars. And it reduced, in this particular example, the incremental carrying cost was 20%. So 20% of the 561,000 is $112,000 a year. And that's real money showing up in operating costs. Next slide. So we want to identify the SOS items, divide it into those categories. Surplus is good, but it's not good if you keep it there. Surplus is good because you should be able to get rid of it at close to your full gross margin pretty quickly. We do this analysis by SKU. We use the groups to create what's called a stocking indicator. And by the way, this is the same format, whether if you're a manufacturer with a raw material inventory or it's finished goods inventory. So again, I like to repeat it. SOS is valuable working capital. It's wasted. Minimal gross profit taking up space. Next slide. This is a different company. This was an industrial parts company. Again, never cleaned house, had high margins. His inventory carrying cost over 30%. I mean, this is a good rule of thumb. If your total carrying cost is 30% or bigger, that means if you had the same stuff in inventory for 3 years, you paid for it twice. Had it for 6 years, you paid for it 3 times. 30% of his SKUs had a 12-month supply or more, and that was 47% of the inventory investment. So these kinds of statistics allow us to quickly get to where the meat of the problem is and produce results. So 30% was greater than a 12-month supply, 40% was greater than a 6-month supply, with 63% of the investment in inventory. Next slide. Now let's just take a look at, it's the same company, looking at it from just the investment in inventory standpoint. 24% of the inventory investment was greater than a 60-month supply. That's like that last column in the inventory aging example that we did a couple slides ago. 43% of the inventory was greater than a 6-month supply. And there you see it graphically. Next slide. Okay, traditionally, look in the upper right-hand corner. The raw data, this is a different business. The raw data, 20% of his SKUs was 87% of sales, of course. The next 20% was 6%. The bottom 60% was 7%. By the way, some people know this as Pareto's curve. 20% of the salesmen produce 80% of the results, 20-80 rule. It rarely comes out 28. I once had a client, it was the industrial parts distributor for many, initially 20% of his items was 93% of the sales. Think about that. That means the bottom 80% of his items was 7% of sales. That's crazy. All right, so I took that raw data and I divided it into 6 groups that relate to stuff that you want to stock, that you don't want to stock. So look at the columns called status. We have the traditional ABC items. Then we have category D. That's obsolete inventory. We created an additional category to it. Now, when we assign that stocking indicator becomes part of the SKU description. So you get the relative importance of it. So D is obsolete. E is a new item that generally less than 12 months. I one situation where an E item was anything that was less than 18 months, only because it took time for these things to grow. That's what the management wanted to look at it as. And then you have a category called non-stocking. Non-stocking is something that I ended up in inventory with it. I want to get rid of it. And it's hard to do. Like if you're in the auto parts business, you don't want to stock an engine or a block, because it's just too expensive. So that's what I call non-stocking. So I took the raw data, I then broke it down into 6 categories, And that's how many where it says number of items, that's the number of SKUs in that particular category for a total of 18,000 SKUs. His targeted turns was 5.02, targeted months, 2.39, and there you see the percent sales for each one of those categories. That's what I mean by stocking indicators. And what it means is that I'm going to have replenishment rules and service level rules that are different for each one of those stocking indicators. You're kidding yourself if you think you can treat all items the same. That's the same thing as having no stocking indicators, and you're not taking advantage of the efficiencies that you have in front of you. Next slide. Let's talk about carrying cost. Very important. Carrying cost is the ownership cost. We mentioned it before. Floor space cost, insurance, taxes. Tax is not an item on inventory in New York State, but some states tax inventory. So here's some typical examples. Floor space cost, excessive material handling, insurance, taxes, obsolescence, shrinkage. And I'm going to redo the slide because the interest should never really in today's world be less than 15%. It's just not possible to have an opportunity cost less than 15%. And an opportunity cost is all the projects that you're not doing because you got all your cash tied up in inventory. So, that's a typical calculation. Now, I mentioned before, there's two types of carrying cost, incremental and total. This is an example of total carrying cost. But what if we, just cut the inventory, but we really couldn't do anything, couldn't rent out the space, we couldn't do this, so the space costs remain the same? Then I would take the floor space cost out of this equation and subtract 31.2 minus 6.5, and I would call that then the incremental carrying cost. So sometimes when you do calculations, you want to use the incremental carrying cost, and sometimes you want to use the total. Next slide. As I said, interest should always be an opportunity, not cost of capital, unless you own a bank. You own a bank, you don't need to talk to me. Shrinkage is becoming a much more serious issue, particularly with valuable, easy-to-market SKUs. I had a client where the guy had scrap copper, had an employee for 18 years. The guy was taking all the scrap copper and stealing it. And should have had that scrap copper as part of his inventory system. And I'm going to repeat because I like to repeat it. If you've had it in inventory for more than 3 years, you paid for it twice. Next slide. Financial controls. Essentially, the financial controls are the metrics. And these should be looked at least some of them on a monthly basis. I like running the inventory aging report at least monthly, the detailed inventory aging report at least monthly, because when you take it out of the stock status file, you get the chance to really see progress. People say, hey, I'm getting rid of that. I got rid of 300,000. I did this, I did that. Oh yeah, let's see it in the report. The proof is in the pudding. So you want to run that excess inventory agings at least once a month. So there's weeks of inventory, excess inventory, fill rate, that's the service level, lost sales, GMROI, and carrying cost. All of those elements should improve if you're working it right, if you're doing the Schoolman Inventory Method. Okay, next slide. Thank you for attending. I'm happy to answer any questions that anybody has. And I think I'm fine with, if anybody wants a copy of this presentation, they can get it. So if there's any questions, I'm game.